Welcome to Heresy Financial. This is the channel where we talk about financial topics in a way that's considered heresy to the financial establishment. Today's question is why low interest rates prop up asset prices, or why low interest rates are considered stimulus. Let's dive in. All right, if you're new to the channel, thanks so much for watching. We are going to be diving into the question of why low interest rates prop up asset prices. Now, if you follow traditional economic explanations of things, you might come away with a little bit of a different answer and conclusion than what we're going to talk about today. But we like to dig into the reality behind the scenes of what's really going on and the long-term implications of artificially manipulating top-down and centralized planning of an economy, because really that's what the Federal Reserve actually does. So the number one reason why low interest rates prop up asset prices and stimulate the economy, it's the most obvious reason. Really, what else are you going to do with your money? If you want to put your money in a savings account right now, or a CD, or even loan your money through a bond, your return on your money is going to be extremely low. In a checking account, you're probably not getting any interest. In a savings account, you might be getting 0.1%. In a CD, you might be getting 1 to 1.5%. In a bond, you might be getting 1.5 to 3%, depending on the investment grade. And so if you want to loan your money out as debt, you're going to get a really poor return on your money. And so having interest rates be really low incentivizes people to do other things with their money instead of loaning through debt. And so big money, instead of loaning their money through debt, will do things like investing in the stock market. If you're a company, like a large institution, a large publicly traded company, you'll probably do a lot of stock buybacks, which we've seen a lot of over the last 10 years, because that drives your stock price up. And so you get an instant improvement in your company's performance by using debt to buy your own stock, which drives the price up. On the other side of that coin, it makes borrowing really easy. It makes debt really easy to come by, because if you need to borrow money, you're not having to borrow it at exorbitantly high interest rates that are making it difficult to pay that debt off. You're able to do things that you might have not been able to do if the interest rates were higher, because it's a lot more affordable to borrow money. Now, the thinking behind this policy is that big money drives the economy, which is largely true. Institutions and central banks and big money is what drives the stock market up or down. It's what drives investment decisions across sectors of the economy. And so when they're making these policy decisions, they're really doing these things with big money in mind, not small retail individual investors in mind. So they want institutions to have the ease of borrowing money at really low rates, because they know that what those institutions will do with that money is things like stock buybacks to drive the stock market up. They'll purchase real estate at really low rates, so that keeps real estate prices up, because there's a lot of money going in to buy things. And when you have a lot of buying pressure, that drives prices up. Basic supply and demand at work here. If you have a lot of people wanting to buy one object, then the person selling that object will be able to ask for a higher and higher price until he gets to a price he actually wants to sell at. And so the more buying pressure you have on any item, whether it's stocks or real estate or businesses or goods and services, the more buying pressure you have, the more that's going to drive prices up. So having debt be really easy and really cheap allows institutions to borrow a lot of money, and what they'll do with that primarily is drive asset prices up by buying assets. Because the number one thing that institutions do with debt is they buy assets. Now, individuals primarily buy liabilities with debt. The average person who has debt will use it to buy their groceries with credit cards. They'll use debt to buy a car. They'll use debt to buy a house, a personal residence. And they'll use debt to buy student loans. And so all of these things are liabilities. Liabilities are things that end up costing you money. They're not things that end up putting money in your pocket, in the words of Robert Kiyosaki. And so individuals will use all this cheap debt, and it'll drive consumer spending, and it'll end up driving the prices of goods and services up higher, because they're buying things like cars, they're buying things like college tuition, they're buying things like houses, they're buying things, regular everyday items with their credit cards. And so the easy debt going to the consumer drives prices of goods and services up. And we've seen a huge increase in the prices of goods and services, especially over the last 10 years. But institutions, again, are the ones that drive the markets. They're the ones that have the majority of the money in the economy. And so what they do with their debt is buy assets. And so that drives asset prices up. up. Now, the third reason why interest rates prop up asset prices is because lowering interest rates is an inflationary tool. I'm going to have to explain this. There are a couple reasons why lowering interest rates is an inflationary policy. Number one, and the biggest reason, is because credit expansion equals money supply expansion. If you want a really great resource on what I'm talking about in this section, number one, I would refer you to Ray Dalio's 30-minute YouTube video on how the economic machine works. He explains really clearly how the economic machine works and what the credit cycles mean, and how the expansion and contraction of the credit supply is the same thing as the money supply, and it causes what we call the business cycle. He goes into it a lot deeper in his most recent book called Principles for Navigating Big Debt Crises. It's a technical read, but it's really interesting if you enjoy this type of material. I'll sum it up here though. To explain why an expansion of credit in an economy is the same thing as an expansion of the money supply, you have to ask the question, what is money? Essentially, if I go buy a house, I'm not using my own cash for that most likely. I'm putting a down payment, but the bank is loaning me the rest of that money. The bank isn't loaning their own money though. They are able to operate out of this system called the fractional reserve system. And so if they have $100,000 on deposit, they can take $90,000 of that person's deposit and loan it out. But they still allow that person to have an equal claim on withdrawing their $100,000 if they want to. When you go buy a house in the system, that expands the amount of money, or at least claims on money, that there are in the system. Because at first, you have a house owner who owns a $100,000 house, you have your own bank account worth $20,000, and somebody else has their bank account worth $100,000. Now, in that small part of the system right now, you have a total money supply of $220,000. Person with a $100,000 house, you with a $20,000 bank account, and another person with $100,000 in the bank. When you go buy this house though, they walk away with $100,000. You purchase this house with $20,000 of your own money and $80,000 of the bank's money. But the bank doesn't use their own money, remember, they use the person who deposited that money in the first place. And so after you complete the purchase of this house, the person who sold you the house walks away with $100,000. You have an asset worth $100,000, but part of the value of that came from this other person's bank account, which was $100,000. You took $80,000 of that, but they still have a claim from the bank on the full $100,000. They haven't locked up their deposit in your mortgage for 30 years. And so now the total money in this system is $300,000. An asset worth $100,000. The person who sold you the house walked away with $100,000, and the person with the deposit at the bank of $100,000. So the money supply in the system expanded by $80,000 because your 20 turned into 100. And again, that came out of thin air. Nothing was produced in this exchange. That expansion of the money supply came from credit that came out of thin air. So anytime you have lending operating out of the fractional reserve system, which lending originates from the bank, and that's how they loan money, is through the fractional reserve system, you have an expansion of the money supply. So as interest rates get lower and lower and lower, banks need to lend out more and more and more to continue keeping the revenue up. Because if rates were at 4% and a bank is continuously loaning out $100,000, and then rates drop to 2%, well, now they have to loan out $200,000 to make the same amount of revenue they were making before. And so low interest rates makes people want to borrow money more, and it also makes lenders have to loan more in order to keep their same amount of revenue. And due to the fractional reserve system, it expands the actual amount of money that's in the system. So anytime you have credit expansion, you have an expansion of the actual money supply. Now, the classical definition of inflation is an expansion of the money supply. Right now, in the current vernacular, we use the word inflation to refer to the increase in prices. The increase in prices is simply a result of inflation. It's not inflation itself. But just to go with the common term inflation, which is used to define the increase in prices, now we need to show why the increase of the money supply impacts prices going up. It goes back to supply and demand. When the money supply increases, there is more money competing for the same amount of goods. So it drives spending. And when spending is driven up on the same amount of goods and services, the prices will go up to compensate. You can't push down on one lever without the other side going up. And so when the money supply expands, through an expansion of credit, you will eventually see a big rise in prices as well. It hits asset prices first through institutions who get the new money first, and then it trickles down to the prices of goods and services increasing, and then after that, then you see it trickle down to wages increasing. Now, a second reason why low interest rates are inflationary is that it makes debt service easier. When interest rates dropped after the financial crisis, you had a lot of people refinance their loans, and most people refinanced their mortgages with 30-year loans again. They didn't go with a 25 or a 20-year loan, they went with a 30-year loan again. And so as interest rates are getting lower, it makes it easier to roll over your debt and to refinance debt with the lower interest debt. Secondly, as asset prices rise, eventually causing prices of goods and services to rise, and then eventually causing wages to rise, over time, that inflation that is happening makes it easier to service debt. And here's a great example. If you look at houses in pretty much any housing market 30 years ago and compare the prices of those houses to what those prices are today, you're going to see a massive increase in the prices of those houses over the last 30 years. Most of the time, those houses are going to be the exact same houses. Maybe they got a new paint job, maybe they got a little bit of an addition or a new roof, but ultimately, similar neighborhood, similar houses. Definitely not enough changes in the average neighborhood to validate an actual value increase that you've seen. In a lot of markets, 30 years ago, houses were, $50,000 to $100,000, whereas now they're $300,000 to $600,000. So you see a massive increase over the last 30 years in the cost of housing. But those houses are the same houses. Their value didn't increase that much. That just shows you how much value the dollar has lost. So that's inflation making debt service easier, because somebody who got a mortgage 30 years ago is paying $50 a month or $75 a month for their mortgage. Whereas somebody who gets a mortgage on that same house today is paying $2,000 or $3,000 a month for that mortgage. Same house. And so as asset prices go up, which then make prices of goods and services go up, which then make wages go up, over the long term, inflation makes debt service easier. Okay, knowing that inflation makes debt service easier is something that usually only the big money people out there really grasp, and especially the United States government. And so they want inflation because they have the most debt, $22 trillion worth of debt. So they need inflation so that as time goes on, it's easier to pay that off. They need low rates to continue so they can continue to roll over this debt. And so low rates enables government borrowing. But as we discussed in the prior video, government borrowing only feeds into the economy. But if it's inflationary spending that's going into the economy, that drives asset prices up, and that drives goods and services prices up. Because essentially you're having money created out of thin air to fund that spending, so that increase in the prices of assets and goods and services is being funded by money that's been created out of thin air. And so back to the supply and demand issue, you have a larger amount of money that's competing for the same amount of goods and services. Now, in this system, it's the asset holders that really benefit, because ultimately, because wages are one of the last things to be affected by inflation, when prices of goods and services go up, that also helps companies. Because if you're selling a product and you look around after a couple years and you realize you're asking the lowest price of any of your competitors, you can raise your price. And so as prices of goods and services slowly tick higher, well, eventually that's going to translate into an increase in revenue for companies who are selling those goods and services. So asset holders are the first ones to be benefited by prices being propped up from inflation, and they're also the second people to be benefited after it hits the prices of goods and services, because eventually that translates back into revenue. So where's the problem with this? It seems like a magic card that the Federal Reserve can just keep on playing over and over again to win the game long term. The downside is when this cycle reverses, and it always has to reverse, because the credit cycle is just that. It's a cycle. Because an economy can only spend as much money as it actually makes. Eventually, all of the prior spending from debt has to be repaid. And so if you go through a massive period of time where most spending and growth was built on debt, all you've done is borrowed that growth from the future and brought it into the present. So at some point when that debt has to be serviced and paid back, well, you're stopping the spending on that future growth to pay back the past growth. And so then you have a decline in asset prices, because if companies' stock prices have only been going up primarily to stock buybacks, and they've been buying back those stocks by borrowing, well, when they have to pay back that debt, eventually they're going to have to sell their stock. And if the stock going up was from buybacks, the stock going down will be a result of them selling that stock. And so the cycle does reverse itself because it's a cycle. And the worst part is when companies start to anticipate, number one, and experience, number two, financial troubles, what's the first thing that goes? Employees, the retail individual. That's the largest expense. And so when you're facing hard times as a company, a lot of times one of the first things you do is you trim the fat and you lay off a bunch of employees. Not only are regular individual employees the last ones to benefit from inflation due to wages being one of the last things to go up, they're also one of the first groups to experience the actual problems from inflation when the cycle reverses, because they're the first ones to start losing their income from job cuts or salary cuts. While in the short term, low interest rates do prop up asset prices and it looks like it helps the economy grow, ultimately it's a cycle. And the only thing that we're doing is borrowing from the future to spend on our present. So that's how lower interest rates prop up asset prices, and that's the problem with it long term. I really hope you enjoyed the content. If you did, please hit that like button, hit that subscribe button, share with a friend that you think would enjoy it as well. Follow me on Twitter. I do a lot of updating throughout the day on financial events that are happening, especially when there's big news going on. And then check out my options course in the description below as well if you want another tool in your trading and investing belt in order to protect yourself against the coming stock market crash and recession. Thank you so much for watching. I really appreciate it. You guys have a great day.